Welcome back to Profit Without Panic. This is lesson number 11. I'm Karl Domm, and today we're diving into how we control the Greeks to profit in different market types. We've already discussed delta, theta, and vega, but to truly exploit the option premium seller's edge, you need to control the higher order Greeks. Otherwise, you risk ending up with a directional strategy. So let's break it down, starting with negative charm and how it plays a key role in non-directional trading. You might think that neutral delta and neutral gamma mean very little risk, but also a less chance for profit. And this is where a second order Greek, charm, comes into play. The goal of a truly non-directional trade, which often has more downside than upside risk, is to have negative charm. Negative charm means that over time, the downside profit hump builds as the T+0 line rises and eventually catches up to the underlying price in an up market. This gives your trade a profit buffer, even in market crashes. Now let's talk about how we manage the Greeks in a sideways market. Sideways markets tend to have tight trading ranges with occasional volatility spikes. This is like a bull market on steroids for the proactively hedged long put broken wing butterfly. In a sideways market, the reasons a non-directional option strategy AMP 122 makes money are the same as why they make money in a bull market, except profits can come much faster. Why? Because negative charm builds the profit hump quicker and the market doesn't have to move as far for the structure to make money. Delta and gamma. The structure stays delta neutral, so minor price changes within the price range don't affect the structure's profit and loss. Flat gamma means delta doesn't change much as the underlying price moves, and this stability lets the structure profit from time decay with little concern for minor price shifts. Theta. Positive theta becomes a huge advantage in a sideways market. As time passes, the short options decay in value, bringing consistent profits the longer the market stays range bound. Vega. Although the structure has negative vega, the volatility spikes in a sideways market are usually manageable. Occasional spikes might push the P&L down temporarily, but the overall design of the strategy helps smooth things out. Charm. Negative charm is the real star in sideways markets. Over time, the downside profit hump rises faster, allowing the structure to make money even with small price movements. This makes the AMP 122 structure extremely efficient in range-bound markets. Grind-down markets, where the underlying price declines relatively slowly over time, present a different set of challenges. A key feature is rising volatility, like we saw in the fourth quarter of 2018 and throughout 2022. These markets push the price below the neutral delta and gamma buffer zones, but that's where the structure shines. In these markets, the initial volatility spike may cause some drawdowns, but as the volatility shock stabilizes, vega starts to recover. Plus, the negative charm continues to build a downside profit hump that eventually catches up with the underlying price, giving the trade an edge as the market declines. Delta and gamma. As the market grinds down, delta might slightly turn positive, but the proper trade plan helps keep delta neutral overall. Flat gamma ensures delta stays relatively stable even as the underlying price drops. Theta and vega. Positive theta remains a strong profit driver as time passes. Even though negative vega becomes a concern due to increasing volatility, the structure's downside profit hump helps offset any potential losses. Charm and Vama. Negative charm accelerates the rise of the downside profit hump, allowing faster recovery in grind-down markets. Managing Vama, which tracks the rate of change of vega with volatility, becomes crucial for optimizing your profits during heightened volatility. Finally, let's talk about managing the Greeks in a crash market. Crashes are fast, steep drops like those we saw on August 24, 2015, February 5, 2018, the 2020 COVID crash, and in the August 5, 2024 volatility spike. In these markets, a rapid price decline beyond the neutral gamma zone And the increase in volatility on a negative vega position puts heavy pressure on the structure. In a crash, the trade initially suffers alongside the market due to the structure's negative vega. But once volatility spikes high enough to activate the hedge component, VAMA kicks in. This is what I call a vega flip. When volatility expands, the P&L moves into positive territory as the structure's long VAMA overcomes the negative vega exposure as the proactive hedges start generating profit. Delta, gamma, and theta. During a crash, delta may turn more positive as the price plummets, but proactive hedging helps soften the blow. Gamma stays relatively flat, while theta's impact on profit diminishes during sharp declines. Vega and VAMA. Negative vega hurts initially, but as volatility rises, VAMA, the rate of change in vega, causes a vega flip. This flip turns the P&L around, driving the structure into profitability as volatility expands. Charm. Negative charm continues to build the downside profit hump, offering a buffer as volatility spikes. However, its effectiveness may be limited by the sheer speed and size of market crashes. By mastering the control of the Greeks across various market environments, you can develop a genuinely non-directional strategy that thrives in rising, sideways, grind down, and crash markets. In the next lesson, I'll explore the 5 essential components of an all-market trading framework. Without these components, the all-market profits framework simply cannot succeed. Click on the video on your screen to continue to the next lesson.